Many people want to know, if I invest in a property in this market, will my property perform as well as the data indicates? Essentially, you want to know if this market is going up or down. In other videos, we will learn how to evaluate the revenue potential of a property, but in this video, we'll learn how to set our expectations about the upside or downside of a market. To do this, we'll compare two markets: Kissimmee, Florida, which is where Disney World is, and Baraboo, Wisconsin, a much smaller market. Let's start with Kissimmee. You might look at a chart like the rental growth and think that, well, Kissimmee has plateaued to a degree. You might worry about oversaturation. Here in Baraboo, on the same chart, you might see that the listing growth has actually risen substantially over the past few years, and you might be worrying about oversupply as well. In both situations, we want to understand, is demand and willingness to pay higher prices keeping up with the growth in supply? To do this, let's look at RevPAR. So back here on Kissimmee, I'm going to scroll down to the bottom where we have our RevPAR historical chart. Now, RevPAR is a single metric to indicate the health of a market's supply and demand. It is a daily calculation that takes the revenue made from all listings that day and divides it by the number of available listings that day, not just the booked ones. So this number helps you see how efficiently a market is using its listings. Here in Kissimmee, I'm going to look at the historical data from the past couple years. And I can see that 2023, the yellow line, was basically across the board a little bit lower than 2022. And that 2024 is starting slightly lower than 2023. Now, if I were to want to invest in Kissimmee, I know I'm going to make money because, again, it is a very well-established market. Lots of listings here, lots of attractions here. But my expectations of upside should be tempered. And that when I start doing property revenue evaluations, if I'm looking at specific properties here, then I'm going to want to factor in, these expectations into my best and worst case scenarios. Now let's look at Baraboo. I'm going to scroll down again to the RevPAR. And I'm going to see over the last couple years that this is actually opposite, that the RevPAR is going up here in Baraboo year over year for the past few years at least. This gives me an indication that the trend of supply and demand here is positive, and there could be upside to investing in this market. As a result, I might want to actually do a little bit more digging to see if there's an opportunity in a particular type of property. To do that, I like to come to revenue, and I like to sort by the how much revenue did listings earn by bedroom, because this can potentially help me see if there's a particular bedroom size that is profitable in this market. You can see there's a spike here in terms of revenue, so I need to be just aware that this is these 3 months are money-making months. I'm going to remove the 6+ bedrooms because I'm just not sure how many bedrooms these actually are. It could be 10 bedrooms, 12. I'm just going to look a little bit deeper. And here I can actually see something interesting. The 2 bedrooms is the light blue line. 2 bedrooms, the average revenue earned by 2-bedroom listings here actually outperforms 1 bedroom, 2 bedroom, or 1 bedroom, 3 bedroom, 4 bedroom, even 5 bedrooms during some months. So 2-bedroom listings in Baraboo could be on my list of opportunities. And I would again want to confirm that the RevPAR for 2-bedroom listings in this market has a positive trend. And yes, I'm seeing something similar to the overall market trend, which is that 2-bedroom listings does have a positive trend in RevPAR. So I am potentially going to add Baraboo to my list of markets to explore further, specifically with 2-bedroom listings, and look at for sale properties that I might be interested in investing in. And again, in other videos, we will learn how to project revenue for those properties. Now, one more note to keep in mind. Looking for specific markets with really high RevPAR numbers is not how to find good investment markets. A high RevPAR number does not mean a better ROI. It just means a positive trend in supply and demand. A high RevPAR number could indicate higher initial investment or operating costs. For example, if we were to look at a market like Aspen, Colorado, I'm assuming this is going to have a very high RevPAR, yes. However, the market score is bad and investability is low, probably because the prices of homes here are so high, and so the entry cost could be exorbitant. Similarly, a low RevPAR might indicate an opportunity for growth. So I'm just saying this so that you use RevPAR to identify markets with positive trends, then drill into those markets to find the best submarkets and property characteristics, and then move on to for sale properties and evaluating revenue for specific properties. Okay, I hope that helps with your investment research.